The S&P 500 is printing all-time highs. The MAG7 index is printing all-time highs. And yet, more stocks are falling than rising. This divergence, broad index strength paired with negative market breadth, is one of the most reliable late-cycle warning signals in equity market history. The driver is concentration. Semiconductors, a single sector, now account for 23% of total S&P 500 market capitalization. That is a record. The last time sector concentration reached these levels, it preceded two of the most significant market dislocations of the past 30 years. This does not mean the rally ends tomorrow. Parabolic moves can extend far beyond what models suggest is rational. But for institutional investors allocating to digital assets, understanding the equity market structure that is currently pulling capital flows is not optional. It is the macro context that shapes every risk decision in crypto for the next 60 to 90 days. Negative breadth is one of those signals that sounds abstract until you understand what it actually measures. An index like the S&P 500 is market cap weighted. This means the largest companies, by definition the companies that have already appreciated the most, have the most influence on the index level. When those largest names surge while the median stock declines, the index can print new all-time highs even as the majority of investors in individual stocks are losing money. This is the environment we are in today. The semiconductor sector, led by names like Nvidia and a handful of others, has driven the index higher while a majority of S&P 500 components trade below their 52-week highs. The 40% bubble concentration rule, which triggers when a single sector is responsible for a historically disproportionate share of index appreciation, has now activated. The previous two activations came before the 75% semiconductor crash in the late 1990s and the 85% collapse following the dot-com peak. This is not a call to short. The sector is 70% off its March lows. Dynamic stops and trend-following discipline are the appropriate tools here, not early contrarian positioning. The numbers tell a clear story about extension. The Philadelphia Semiconductor Index, SOX, is up 70.7% from its March lows, a move that would represent an entire multi-year bull cycle for most assets, compressed into weeks. The sector now trades 63% above its 200-day moving average. For context, a reading above 20% is typically considered significantly extended. At 63%, we are in territory that historically correlates with late-stage parabolic behavior. The weekly RSI is approaching 90. In the history of the SOX index, touching the 90 level on the weekly RSI has preceded two of the most significant crashes in semiconductor history, a 75% drawdown in the mid-1990s analog cycle and an 85% drawdown following the dot-com peak. We are not at that inflection yet. But the setup is identical. The playbook for institutional holders is not to exit. It is to trail stops aggressively on the hourly time frame, respect every major pivot low, and have a predefined exit plan before the reversal, not after. Bitcoin is forming a textbook ascending wedge on the daily and weekly timeframes, a pattern defined by higher highs and higher lows that converge into a narrowing range, paired with a critically important feature, declining volume. This volume divergence is the core signal. In a healthy uptrend, volume expands as price makes new highs, confirming participation. Here, volume is contracting as price grinds higher, indicating that the rally is increasingly unsupported by new buyers entering the market. The ascending wedge in conjunction with declining volume has a strong historical bias toward downside resolution, particularly when the prior trend was bearish, as it remains in Bitcoin's case from the all-time high. The institutional framework for this structure: do not short into the wedge, but do not add to long exposure without a confirmed breakout above the resistance zone. The market needs 3 consecutive candle opens and closes above $78,900 to establish genuine acceptance at that level. Without that confirmation, every touch of resistance is a potential reversal point. There are 3 distinct Bitcoin scenarios institutional traders are working with heading into this week's CPI print and the Senate's Crypto Clarity Act review. The base case: Bitcoin needs to close multiple daily candles above $78,900, then mount a challenge of the 200-day and 200-week moving average cluster that sits between $81,000 and $84,000. If that cluster flips to support, the path to $85,000 opens, and the short cycle thesis, that the $60,000 floor holds as the bear market low, gains significant validity. The bear case: rejection at the ascending wedge resistance sends price back towards $75,000, potentially retesting the prior cycle structure. The derivatives market is leaning bearish. Current funding shows a 5.78% negative skew, meaning the market is paying more to be short than long. This is consistent with an environment where large players are hedging against a leg down rather than aggressively positioning for a breakout. The bull case, a high-volume weekly close above $85,000 followed by a clean reclaim of $90,000 on expanding volume, would represent a complete technical breakdown of the bearish thesis. At that point, the $60,000 low holds as the bear market bottom, the shortest bear market in Bitcoin's history. This week presents a convergence of two macro catalysts that institutional crypto allocators need to evaluate independently. First, the April CPI print. Consensus forecasts call for a move from 3.3% to 3.7%, a meaningful step higher that would typically be interpreted as dollar bullish and risk asset bearish. However, the Federal Reserve transition is adding complexity. Jerome Powell's term ends within days and Kevin Warsh is positioned to become the new Fed chair. Warsh is historically more hawkish, which argues for continued dollar strength, a headwind for Bitcoin's dollar-denominated price. The Crypto Clarity Act is the second catalyst and perhaps the more significant one for structural positioning. A 75% polymarket probability of passage is high by legislative standards. But institutional experience across every major crypto regulatory event suggests caution. The passage of favorable regulation frequently triggers the classic buy the rumor, sell the news dynamic. Institutions that are positioned ahead of the vote may use the actual passage as a liquidity event to reduce exposure. This does not negate the long-term positive implications of regulatory clarity for custody and institutional product development. It simply means the immediate price reaction may be counterintuitive. Institutional risk management requires predefined conditions, not reactive decision-making under pressure. 4 signals, if they materialize, would warrant a meaningful reassessment of current digital asset positioning. First, Bitcoin's inability to achieve 3 consecutive daily closes above $78,900. This is the minimum bar for structural improvement. Without it, the wedge pattern maintains its bearish resolution bias. Second, a break in the semiconductor hourly trend. The SOX hourly chart has functioned as a leading indicator for risk appetite throughout this cycle. When that structure breaks, equity-correlated crypto assets typically follow within hours to days. Third, DXY reclaiming 100. The current battle at 98 is a critical inflection point. If dollar bulls retake control, the macro tailwind for crypto pricing in dollars weakens materially. Fourth and most operationally important, if the Crypto Clarity Act passes and Bitcoin immediately sells off, this reveals the hand of institutional sellers who had been holding for the regulatory catalyst. That pattern, buy the rumor, sell the news with no subsequent recovery, signals distribution, not accumulation. Predefine these thresholds now. The worst risk management decisions in financial markets are made in real time under stress, not in advance with a clear framework. 5 conclusions for institutional positioning this week. 1. The semiconductor sector's technical readings, 23% of S&P 500 market cap, 63% above its 200-day, weekly RSI approaching 90, are historically consistent with late-stage parabolic behavior. The trend is your partner. Dynamic stops are your risk manager. Neither complacency nor early short selling is appropriate. 2. Bitcoin's ascending wedge with declining volume is the defining technical structure of the moment. 3 confirmed daily closes above $78,900 is the minimum evidence required before institutional buyers have a high conviction entry. 3. The derivative skew tells you where institutional money is positioned. At minus 5.78% negative, more capital is paying to be short than long. This is not retail panic. It is sophisticated hedging from players who are long spot and protecting against the wedge resolution. 4. This week's macro events, CPI and potentially the Clarity Act, are event risks that can move price violently in either direction. If you are holding risk into these events, stops are non-negotiable. 5. The only condition that fully invalidates the bearish macro thesis is a high-volume weekly close above $90,000. Everything below that level is still range trading within a structure that, until proven otherwise, remains a potential continuation lower. Plan your scenarios now. The market will move before you finish your analysis.